Congratulations on your first $1,000. Saving money is important. You did it. You saved $1,000. That is a big step. You should be proud of yourself. Now let's make that money grow. Let's talk about investing. Investing might sound scary, but it doesn't have to be. With a little knowledge, you can make your money work for you. This guide will teach you the basics. You will learn how to invest your first $1,000. Are you ready? Let's get started. Before you invest, there are two things you need. First, you need an emergency fund. This is money you can access quickly. You might need it for unexpected expenses. Car repairs or medical bills are examples of unexpected expenses. Second, pay off high-interest debt. Credit card debt often has high interest. This debt can grow quickly. It is important to pay it off as soon as possible. Once you have these two things covered, you can start investing. Investing is for the long term. It's about growing your money over time. Index funds and ETFs are great for beginners. They offer a simple and effective way to start investing without needing to pick individual stocks. This can be particularly beneficial for those who are new to the world of investing and may not have the time or expertise to analyze individual companies. They are like baskets of stocks. Imagine having a basket that contains a variety of different fruits. If one fruit goes bad, you still have plenty of others to enjoy. Similarly, if one stock in your index fund or ETF performs poorly, the impact on your overall investment is minimized because you have many other stocks in the basket. This helps to spread your risk. Diversification is a key principle in investing. By spreading your investments across a wide range of assets, you reduce the risk of any single investment significantly affecting your overall portfolio. This can provide a more stable and predictable return over time. An index fund tracks a specific market index. This means that the performance of the index fund mirrors the performance of the market index it is tracking. For example, if the market index goes up by 5%, the index fund should also go up by approximately the same amount. The S&P 500 is an example of a market index. It is one of the most well-known and widely followed indices in the world. It includes 500 of the largest publicly traded companies in the United States, providing a broad representation of the overall market. It includes 500 large companies. These companies span various industries including technology, healthcare, finance, and consumer goods. By investing in an index fund that tracks the S&P 500, you are essentially investing in a small piece of each of these companies. ETFs are similar to index funds. They also provide a way to invest in a diversified portfolio of assets. However, there are some key differences between the two that investors should be aware of. They also track a basket of assets. This can include stocks, bonds, commodities, or a mix of different asset types. This allows investors to gain exposure to a wide range of investments through a single ETF, but ETFs trade on stock exchanges. This means that, unlike index funds which are priced once at the end of each trading day, ETFs can be bought and sold throughout the trading day at market prices. This provides greater flexibility for investors who want to take advantage of intraday price movements. This means you can buy and sell them throughout the day. This can be particularly advantageous for active traders who want to respond quickly to market changes. However, it also means that ETF prices can be more volatile compared to index funds. Pros: diversification. You invest in many companies at once. This reduces the risk associated with investing in individual stocks and can lead to more stable returns over time. Diversification is one of the main reasons why many investors choose index funds and ETFs. Low fees. Index funds and ETFs have lower fees than other investments. This is because they are passively managed, meaning they simply track a market index rather than trying to outperform it. Lower fees can have a significant impact on your overall returns, especially over the long term. Cons: lower potential returns. Your gains might be smaller compared to individual stocks. While index funds and ETFs provide more stable returns, they may not offer the same potential for high returns as investing in individual stocks. This is because they are designed to match the market's performance, not beat it. How to invest. 1. Open a brokerage account. This is the first step to start investing in index funds and ETFs. There are many online brokerage platforms available that make it easy to open an account and start investing. 2. Choose an index fund or ETF. Research different options and choose one that aligns with your investment goals and risk tolerance. Look at factors such as the fund's performance, fees, and the types of assets it holds. 3. Decide how much you want to invest. 4. Buy your shares. determine how much money you want to invest, and then purchase shares of the index fund or ETF through your brokerage account. It's that simple. With these steps, you're on your way to building a diversified investment portfolio that can help you achieve steady growth over time. Fractional shares let you buy parts of a share. This means you don't need to have a large sum of money to start investing in the stock market. Instead of saving up to buy a whole share, you can start with just a small amount of money. This opens up the world of investing to more people, making it more accessible and inclusive. This is great if you want to invest in expensive companies. Many well-known companies have high stock prices that can be out of reach for the average investor. With fractional shares, you can still own a piece of these companies without needing to invest a large amount of money up front. This allows you to diversify your portfolio and invest in companies you believe in, even if their stock prices are high. Imagine a company's stock costs $1,000 per share. For many people, this is a significant amount of money to invest in a single stock. However, with fractional shares, you don't need to come up with the full amount. You can invest a smaller amount and still gain exposure to the company's performance. This makes investing more flexible and allows you to spread your investments across multiple stocks. With fractional shares, you can buy a portion of that share. This means you can start investing with as little as a few dollars. It's a great way to get started in the stock market without needing a large amount of capital. You can gradually build your investment portfolio over time, adding more fractional shares as you go. This approach allows you to learn about investing and gain experience without taking on too much risk. You could invest $100 or even $10. This flexibility is one of the biggest advantages of fractional shares. It allows you to invest according to your budget and financial goals. Whether you have a small amount of money to invest or a larger sum, fractional shares give you the opportunity to participate in the stock market. This can be especially beneficial for new investors who are just starting out and want to test the waters before committing more money. Pros: affordability. Invest in expensive companies with less money. This makes it easier for more people to start investing and build their wealth over time. You don't need to wait until you have a large sum of money to buy a whole share. Instead, you can start small and gradually increase your investments as you become more comfortable with the stock market. This approach can help you develop good investing habits and build a diversified portfolio. Flexibility. Buy shares that fit your budget. Fractional shares give you the freedom to invest according to your financial situation. You can adjust your investment amounts based on your budget and financial goals. This flexibility allows you to take advantage of investment opportunities as they arise, without needing to come up with a large amount of money up front. It also makes it easier to diversify your portfolio and spread your risk across multiple stocks. Cons: limited availability. Not all brokers offer fractional shares. This means you may need to do some research to find a broker that offers this option. Additionally, not all stocks are available for fractional investing. Some brokers may only offer fractional shares for certain stocks, which can limit your investment options. It's important to understand these limitations and choose a broker that meets your needs. How to invest. 1. Find a broker that offers fractional shares. This is the first step to getting started with fractional investing. Look for a broker that has a good reputation and offers a wide range of stocks for fractional investing. You can compare different brokers based on their fees, features, and customer reviews to find the best option for you. 2. Choose the company you're interested in. Once you've found a broker, the next step is to decide which companies you want to invest in. Look for companies that you believe in and that have a strong track record of performance. You can research different companies and their financials to make an informed decision. This will help you build a diversified portfolio that aligns with your investment goals. 3. Decide how much you want to invest. This is where the flexibility of fractional shares comes in. You can choose to invest a small amount or a larger sum, depending on your budget and financial goals. It's important to consider your overall investment strategy and how much risk you're willing to take on. This will help you determine the right amount to invest in each company. 4. Buy your fractional shares. Once you've decided how much to invest, you can go ahead and purchase your fractional shares. This process is usually straightforward and can be done through your broker's trading platform. After your purchase, you can monitor your investments and make adjustments as needed. Fractional shares make it easy to start investing and build your portfolio over time. Robo-advisors, your personal investing assistant. Robo-advisors are digital platforms designed to help you manage your investments with ease and efficiency. They leverage advanced algorithms and data analytics to make informed decisions on your behalf. They create and manage investment portfolios for you, taking into account various factors such as market trends, economic indicators, and your personal financial situation. They ask you about your financial goals and risk tolerance. This information is crucial as it helps the robo-advisor understand your investment preferences and tailor a strategy that aligns with your objectives. Then, they build a portfolio tailored to your needs. Pros: easy to use. These platforms are designed with user-friendly interfaces that make the investment process straightforward and accessible. Ideal for beginners who prefer a hands-off approach. Automated, rebalances your portfolio automatically. This means that the robo-advisor will periodically adjust your investments to maintain the desired asset allocation, ensuring that your portfolio remains aligned with your goals. Cons: fees. Robo-advisors charge fees for their services. These fees can vary depending on the platform and the level of service provided. It's important to compare different robo-advisors to find one that offers the best value for your needs. Less control, you have limited control over your investment choices. While robo-advisors offer a convenient way to invest, they may not provide the same level of customization as a human financial advisor. How to get started. 1. Research and compare different robo-advisors. Look at their features, fees, and performance history to find one that suits your needs. Choose a robo-advisor. 2. Create an account and answer questions about your finances. This step is essential as it helps the platform understand your financial situation and investment goals. Provide accurate information to ensure that the robo-advisor can create a portfolio that truly reflects your needs. 3. Deposit money into your account. Most platforms have a minimum deposit requirement, so be sure to check this before you start. Once your account is funded, the robo-advisor will begin investing your money according to the strategy it has developed for you. 4. Monitor your investments. While robo-advisors handle the day-to-day management, it's still important to keep an eye on your portfolio to ensure it continues to meet your needs. The robo-advisor will invest your money for you, making adjustments as needed to keep your portfolio on track. With the right robo-advisor, you can achieve your financial goals with minimal effort and maximum efficiency. Avoiding common investment pitfalls. Investing can be tricky. Here are some common mistakes to avoid. Emotional investing. Don't make decisions based on fear or excitement. Timing the market. It's almost impossible to consistently buy low and sell high. Putting all your eggs in one basket. Diversify your investments. Tips for success. Do your research. Understand what you're investing in. Start small, and gradually increase your investments over time. Be patient. Investing is a marathon, not a sprint. The power of compounding. A real-life example. Imagine you invest $1,000 today. It earns an average annual return of 7%. In 30 years, your investment could grow to over $7,600. This is the power of compounding. The earlier you start investing, the more time your money has to grow. Even small amounts can make a big difference over time. Ready, set, invest. Investing can be scary at first, but remember, you don't need to be an expert. Start small. Learn as you go. You've already taken the first step by saving $1,000. Now it's time to take the next step and start investing. Your future self will thank you. Your journey to financial freedom starts now. Investing is a journey. There will be ups and downs along the way, but by staying informed and sticking to your plan, you can achieve your financial goals. Remember, the best time to invest was yesterday. The second best time is today. Don't forget to like, subscribe, share the link with friends and families, and smash the notification bell for more financial insights.